Welcome to Market Manipulation TV, where I tell you what the market does, and the market does exactly that. On today's show, we're tackling the biggest risks to this market, the US election, earnings, and why volatility is here to stay. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks closed Tuesday's trading in a sea of green as Americans flocked to the polls on election day to decide whether Kamala or Donald Trump would become the next president of the United States. Now, just quickly looking at the polls right before we actually get the official results. As it is right now, the market has a 62.1% chance of Donald winning, 38% of Kamala winning. But some of the price action we went today swung in favor of Kamala. That being said, the overwhelming majority is for Donald Trump to win this election. Now, there wasn't really much to say on the market. It really just was a sea of green. I think the best thing that we can do is actually talk about the red we saw. First, NXPI was down 5%, but that didn't hamper the overall sentiment in semis. That was because of NXPI's earnings. Their earnings are also highly correlated to China as well as the auto industry, and there's a lot of cyclicality. Boeing was down 2% after some news on its strike. A deal has not been struck, I believe, and that's why there was a bit of volatility in that name. But other than that, it was a sea of green everywhere. The worst performing sector was materials, up 0.17%. The S&P 500 gained 1.19%. In the middle of the pack, the best performing sectors here was XLY discretionary, industrials, utilities, technology, real estate. Very Trump heavy trades really led the pack today. And then we look at stuff like comm services, financials, healthcare, energy, staples. They also led the pack today. There wasn't really anything to say. I mean, markets opened and it was just higher highs, higher lows all the way into the close. We did see a little volatility from midday, but we really just put in a bottom and then went to go retake the highs here in the markets. And it was small caps, mid caps, large caps, particularly growth, but really you couldn't fault the market today. It was green everywhere. Globally too, Australia was red. Some parts of Europe were red, but I mean, Asia, very green. North America, very green. South America, very green. It was a bullish day all round. But looking at some of the highlights of the day, Super Micro was up 6% on the day, but down 9% here in the after hours. And that's because they missed Wall Street's expectations on both earnings and revenue. It was a double miss. Guidance didn't come in line, but regardless, I would take these earnings with a grain of salt because you can't really trust this board right now. Now, the reason why the stock was up 6% today is because SMCI actually promoted an independent committee to do an investigation on their audit committee and their board. And the independent counsel found that the audit committee had acted independently and there was no evidence of fraud or misconduct on the part of management or the board. Also, what didn't help sentiment is that the Nasdaq gave SMCI notice 60 days to remedy a whole bunch of stuff, or they were going to delist. So they have 60 days to find a new auditor and release an audited 10K filing. If they don't do that, the stock will delist. So guys, you want to stay as far away from this name as possible. Don't buy these stocks. Get out if you're in right now. Anything to do with fraud, you don't want your money near. Another big mover today was actually ticker symbol RACE, Race or Ferrari, a amazing company, a stock I've always wanted to get into, but never got there because of valuation. Now, earnings was fantastic. Revenue beat by a wide margin. EPS beat as well, but total shipments dropped 2% on the back of a 29% drop from the China region. So China's decline saw overall shipments fell, and that's why the stock was down 7.2%. Hopefully this keeps going low. If we can get Ferrari below 400, I am a huge buyer. I really like the stock. They got world-class margins, an exclusive brand. Probably their brand is a moat in itself, even bigger than some of the luxury brand names. Ferrari is the epitome of luxury. Guys, we also had had Palantir today. They were up 22% after yesterday's earnings. It was a double beat, a raise, government contracts boosting earnings, but there's just so much demand for that product. And that's why the stock was at $50. I said the stock would trade at $50 before the end of the week, and so it did. And regardless of what you think of valuation, the stock will continue to move higher. But let's talk about the broader market. And after today's trading, guys, we saw breadth momentum pick up in a very, very big way. Breadth was looking shaky coming into today, but things looked very, very good. We saw 91 new 52-week highs in the New York Stock Exchange, 92 in the NASDAQ versus 43 new 52-week lows and 86 new 52-week lows. 79% of stocks were advancing and 70% for the NYSE and the NASDAQ exchanges. And then looking at overall market momentum, we saw a recapture of the 5-day, 20-day, and 50-day moving averages. Breadth looking very, very strong. And yes, these are noisy, but when we have them, we have them. And our shorter term breadth metrics look really good after today's strong day. Medium term looks great. Longer term looks really, really good. Everything is looked poised to go higher for stocks. And like I've been saying for the last couple of days, guys, the volatility we do get, buy these dips, because at the end of the day, bulls come in very, very quickly in bull markets, scoop up the lows and take us higher in very bullish fashion. And that's exactly what we saw in today's trade. Let me show you on the charts. Now, stocks across the board, extremely bullish. And we're also seeing some very bullish momentum here in the after hours. The NASDAQ 100, S&P 500 up 1.2, 1.3% respectively. The IWM up nearly 2%, just shy of 2%. But on the full day, excluding extended hours trading, we're up 2% on the day. A huge move for small caps, and do expect that move to continue. Guys, we also saw upward momentum in mid caps, and look at the S&P 600 profitable small caps up 2.03% on the day. Very, very robust momentum. And this move was in large part due to a number of factors. While you do see yields are green here, this is actually after hours. If we pull up the 10-year yield, we can see that the 10-year yield was down 0.33%. But if we actually zoom in, look at it from its highs. We had a huge move down in yields from the highs of the day. We also saw a drop in the dollar. The dollar fell 0.44%, and that just overall supported the price action in equities today. That's why we saw a little bit of a bounce. Commodities didn't do that great. Gold was flat, silver up 0.64, crude was up 0.76% today, but lower yields and a lower dollar just supported equities, especially after we've had a little bit of a downtrend into the lows we've seen right here. And this is very, very constructive because we put in lows and we are moving higher across all of the indices. This is the S&P 500. And guys, this is actually looking like a higher low relative to this low right here. On a technical basis, that's exactly what you want to see. We bounced off the put support at this low right here. We're back into positive gamma, and that's a very, very bullish candle right there. To see follow through tomorrow, what needs to happen? We just need to close that gap right there. And things in the after hours looking like we might actually go ahead and do that. The SPY up 0.11% in the after hours. So we put in a low that is actually a higher low. And if we go ahead, close this gap tomorrow, we can then reach for new all-time highs. But we are in positive gamma now, and that means you buy dips, sell rips. And look how good these lines work, guys. At the put support, you actually want to be buyers if we are in negative gamma and go higher. That's exactly what we saw today. You know, buyers, yeah, they didn't touch the put support, but this isn't an exact science. You look at these as levels and ranges, and we bounced off the put support, went into positive gamma, and that means we buy dips, sell rips, looking to go higher. But there are some risks, because if stuff goes wrong, maybe with the election volatility or FOMC, we can go back into negative gamma, and then we would then target the put support. But as it is right now, we've closed in positive gamma, so our target is 59.05, and that means we want to close this gap and look for all-time highs, and then the 59.05 area. That is the levels for the S&P 500. For the NASDAQ 100, we saw very similar price action. A higher low relative to this low right here. Support found at the put support. We're in positive gamma. That means our target is the 20,675 area. Those highs close the gap, and then all-time highs here for the NASDAQ 100. And then looking at the RTY, very similar situation, guys. The RTY looking the most bullish relatively speaking. We put in a higher low, went from negative gamma into positive gamma, found support at the put support, but the IWM, there isn't a gap to close. We actually closed at the highs we made last week, and that means we can go target these 52-week highs and above. We just need a push to the 52-week highs in the IWM, and then we can go from there onward and upward to all-time highs. Very constructive price action in equities, and that's what I've been saying all week. Equities look poised to go higher, and I think that's what's going to happen. We are going to go higher into the end of the year. We are in a period where we just have shorter trading weeks, less trading days. That means there's more volume on the average day. Buybacks are officially coming back. 80% of market cap stocks will be out of the blackout period by the end of this week. We'll have the election behind us. We'll have the FOMC behind us. And then there's just a lot of tailwinds for equities, and the path of least resistance is higher, coupled with an earnings season that's going really, really good right now. I know the market getting a bit jittery with guidance and capex, but when you look at the earnings in the year and now, earnings are very, very solid and we're smashing expectations. And that's why stocks are very, very resilient. And the path of least resistance is high. I do think we finished very close to the 6,000 level in the S&P 500 before the end of the year. And then looking at the RSP, a very bullish day for the RSP. This is exactly the level where I said to buy, guys. Right here, the 176, we said if we break below, we would target the 170 to 172. We did not. We found support right here, and it's just onward and upward. And for the RSP, we just target, the 180 level, the 182, and that's new all-time highs. Very, very simple. Don't overcomplicate your trading, guys. Buy the indices, buy the index, and then go from there. And if you're looking for specific names, guys, I really do like Paycom. Paycom is going to go higher. I think we're going to see by the end of the year, this name close to the 230, 235 level. I still see upside. It's overvalued, but right now I'm in the hold mode. I also do like PayPal, guys. I'm going to release a video on my overall thoughts on PayPal and Paycom's earnings, but PayPal looking very, very constructive. We're pretty much back at the $80 level right here. So a bit of a sell-off to the 76 region, but we held these lows right here. And I do think we're going to see price discovery back to these highs into the fourth quarter earnings, which should be a blockbuster earnings. I also like Google. I think we're going to go recapture these highs before the end of the year, maybe all-time highs. Other names I do like, a name I recently started buying a lot of. So for those of you that are Australian investors, this is a name I really like, but it's more of a small cap position. Maybe keep this only 5% or so of your portfolio. Nothing too big because there's a lot of risk with the UK expansion with this name. But those are names I like apart from the normal indices. I also like the NASDAQ 100, guys, the S&P 500, the RSP, the CARF index, as well as MOAT, the MOAT ETF. So if you're looking for individual names, there you go. I know I've said these names before in previous videos, but I still like them. You should see some plenty upside for these names as well as the indices. But let's actually first get past the selection, get past the FOMC, and then we could rally from there. It just seems like the market was sort of front running just a lot of the tailwinds that is to come after the FOMC and the election. Nonetheless, we will take green days as they come, guys, and we are in positive gamma in all of our major three indices, the S&P 500, the NASDAQ 100, as well as the RTY, and that means we buy dip, sell rips to our upper levels, which is the 2300 for the RTY. For the NASDAQ 100, that's the 2675 area, and the S&P 500, that's the 5905 area. So guys, buy the dip, don't trip. This is CNN's Fear and Greed Index, and we have to talk about sentiment and what's driving the market right now. And fear is driving the US market. We were in the neutral zone yesterday. We were in the greed zone last week, and we've pulled back into this fear zone, although just inside the fear category, as you can see. Now we have to ask the question, why is fear driving the market? And if we also look at S&P 500 implied moves, we could see elevated implied moves resulting in elevated volatility. And we know this because this dotted line right here is the average 3-month realized volatility, and we are well above that level. And the implied move is to stay above that level up until the middle of November, at least for most days in the next couple of weeks. And the reason why we're seeing this heightened volatility has to do with a very big near-term risk that isn't fully discounted into the market. And that near-term risk is not FOMC. In fact, the odds are that we do get a 25 basis point rate cut on Thursday. Nothing has changed there. The biggest risk to this market is actually a divided government right now. The US dollar has actually tracked GOP sweep odds, meaning that the market is anticipating a GOP sweep. That big risk is if we get an election surprise, and that means this has to re-rate and is vulnerable to reverse reverse in a very big way if we get a surprise outcome. And that's why we're seeing elevated implied moves and fear in this market right now, regardless of what's happening with the FOMC. But these are all near-term risks. Big picture, stocks tend to do well after the election. And if we actually exclude 2008 as well as the year 2000, we can see that stocks 6 months after an election actually outperform leading up into an election, meaning we should get further gains in this market if history is to tell us anything. And the macro environment is nothing like the year 2000 or 2008. So do expect further momentum to continue, but near-term volatility to rear its head. So what does that mean, guys? Any dips we do get, volatility we do get, buy those dips because we do tend to see very solid returns 6 months after an election. And diving into the macro, looking at the overall economy, this is the Fed's GDP now. And after the factory orders data we got yesterday, as well as the labor report on Friday, we saw the GDP now estimate, which is just real GDP tracking for the fourth quarter. It fell to 2.6% at this level right here. And given the data we actually got from non-farms, a 12K print, you would think that this would be an absolute dumpster fire. That is simply not the case, telling us that the labor report, the NFP report, was more noise than anything else. And largely the Fed's number right now is at the top end range of the blue chip consensus. Adding on to the employment data, this is Goldman Sachs. They expect job gains and real wage growth to slow somewhat from their 2024 average, but they expect the employment market to remain very robust, tracking about 150,000 job gains every single month for most of 2025. They also expect solid income growth across the income distribution next year, from the bottom all the way to the 5th percentile, and overall they're expecting a 2.5% real income growth forecast for 2025. Very, very solid. Disposable income and employee compensation looks like it's going to outstrip inflation above the 2.5% to 3% range, with PCE and CPI expected to be about 2% at the end of the year. That is very, very bullish for the consumer. Consumer spending, however, at the bottom of the income distribution slowed in 2023 and 2022, but has since caught up with overall spending, as you can see right here. And largely, what we are seeing with the consumer is continued normalization, and labor income has been the key driver of that real income growth, which has kept spending growth this year very robust, and this will likely continue to support the consumer into 2025, especially when you have employee compensation and disposable income outpacing the rate of inflation. Looking at earnings tomorrow, guys, we have a couple of very big names: Celsius in the energy drink space, Novo in the healthcare space, CVS Health. So they're reporting before the bell. We also have Toyota, but the real market moves are going to be Novo, CVS, and Celsius. And then after the close, we have ARM, AMC, Qualcomm, Elf, AppLovin Corporation, as well as Mercado Libre. So a pretty big day of earnings tomorrow, a pretty big day today as well. But then data is actually looking very light. So there's not much happening here on Wednesday. We just have a 30-year bond auction. That's pretty much it. And then the real data gets going on Thursday, but we'll talk about that tomorrow. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.